Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Peter Boockvar. He's the Chief Investment Officer for the Bleakley Financial Group and Advisory. He has a newsletter product called the bookreport.com, BOOCKREPORT, and that has great economic insight and perspective with lots of updates on economic indicators. Welcome, Peter.
Thanks, Rich, for having me.
Great. I thought we'd begin with recent observation you made saying basically we are on the other side of an unprecedented experience of monetary largesse and experiment. Just wondering if you could elaborate on that. What were your thoughts?
Yeah, so the liquidity tide is beginning to go out. It's more pronounced in the U.S. with the 6 interest rates that we've seen so far, in addition to the Fed's balance sheet beginning to roll off. Beginning on Monday, the trend in terms of that roll-off will go from $60 billion a quarter. It was $30 billion in Q4, and it will increase to $90 billion a quarter in Q2. Also, as each day and week and month goes by, we get closer to the ECB finishing their quantitative easing program. And we know the Bank of Japan has been buying less JGBs as they focus more on yield curve control. Had some couple of rate hikes from the Bank of Canada. We're going to get a rate hike from the Bank of England in May. So this is central bank attempts to extricate themselves from many years of extraordinary policy. So that's why I refer to this as the other side of the mountain. Easing is very easy. Throwing that party is very easy. Trying to control the hangover in a pretty benign way is now the hard part.
And so are all central banks, major central banks in the world doing this, or just a portion?
Well, the major ones in some fashion are. I mean, even though the ECB is still doing QE, they cut it in half as of January. They'll probably end it by the end of the year with another sharp taper come October 1st. So doing this all together, at the same time, valuations across the world are stretched, both in fixed income and equities. And it creates vulnerability. I mean, anytime central banks are in a tightening cycle, the world becomes more vulnerable, both in terms of growth and on an economy that's very dependent on extraordinary low rates, and also on asset prices that have become very, very elevated. So if you believe in a free lunch, then everything will be fine. If you don't believe in a free lunch, to 7 years of zero interest rates, a quintupling of the Fed balance sheet, and negative interest rates around the world, then you should be more circumspect of how this all turns out.
Now, looking at the Federal Reserve, how high can interest rates go before other problems begin to set in, namely the challenge of servicing the debt and also on interest rate related derivatives?
Well, look what happened to the VIX trade, the short VIX trade. We saw a 30 basis point increase in the 10-year yield, 30 basis points, that's it. And it blew up an entire trade. So I think that was one sign of how sensitive we are to modest changes in interest rates. Again, because we've been so many years attached and addicted and dependent on extraordinarily low rates, both in terms of its impact on the economy and certainly asset prices. So I think that was, again, one sign of potentially more to come. Now the question is to this persistent rise in interest rates, particularly on the short end and certainly with LIBOR, does this rise in the cost of capital, does this rise in the cost of servicing one's debt begin to impact free cash flows? And maybe not yet, but we seem to be heading in that direction.
And so at some point, will the Federal Reserve and other central banks be constrained or limited in its normalization process?
That's a good question. I think the restraint will occur only if something breaks. And I think they seem pretty intent on raising at least 2 more times this year. I think they'll sort of front load that to give them the option of whether they want to do a fourth one at the end of the year. And they claim that the shrinking of the balance sheet is like watching paint dry and will happen in the background. But we know that if something happens, if markets fall, if the economy gets impacted, then the Fed will certainly reevaluate that policy. But the problem is that if they don't do the type of tightening that they want to do, and that it somehow gets short-circuited by the markets, it tells you that the Fed is trapped in what they've created, and that them and the ECB and the Bank of England, we've all become Japan. And we had many years of lessons to learn from the Japanese and the Bank of Japan getting trapped in their monetary policy, and we learned none of that lessons. Bernanke, supposed student of the Great Depression in Japan, apparently studied the wrong thing, because look at the situation that we're in. And the Fed funds rate is 1.625% in the U.S. in the 9th year of an economic recovery, and they just started shrinking their balance sheet. So we're in dangerous land here in terms of this unwind. And if things were to fall in terms of the economy or markets, the question is, what is the strike price of the Fed put? And how would the Fed deal with it if we hit that strike? Are we just going to see more rate cuts all of a sudden? Well, they don't have really many rates to cut. So this is going to be an interesting situation in the coming years.
And if there is movement into recession territory, also a fall in the financial markets, would the Federal Reserve and other central banks be in a position to decrease interest rates, and would that mean going into negative nominal interest rate territory?
I do not believe the Fed will ever go to negative nominal interest rates. I think you'll blow up the money market fund. I think there'd be riots in the streets of Washington, particularly from the AARP. So I don't see that being politically possible. And at the same time, I think it's proven that it's really not a good policy. Negative interest rates is a tax on capital. It's a tax on banks, and banks will do their best to pass it on. And if they don't, then they eat it themselves. But somebody has to eat the tax. So I don't understand the economic model to how negative interest rates is actually a good thing. I mean, I understand their concept that it may force banks to go out and lend, but it's still a tax that's being eaten by somebody.
What about going into negative real interest rates by maybe forcing inflation to much higher levels?
Well, we've been in a negative interest rate environment for 10 years now, so that's not like it would be anything new. It would just really be more of the same. And in fact, it's negative real interest rates. It's what got us into this mess anyway, in terms of creating all this debt and bubble type environment that we consistently seem to get ourselves into.
Speaking of tax on capital, what do you make of the recent developments on trade in terms of trade tariffs acting as a sort of effective tax on the global economy?
Well, optically, it certainly is, I believe, a big negative. And I say optically because I'm not sure reality-wise it will be. I mean, you look at the steel tariffs, about 70% of the countries that we do business with have already been exempted. Half of our aluminum imports come from Canada, and they've already been exempted. So on a dollar basis, I'm not sure it'll have that much of an impact. It will certainly hurt, particularly since the users of steel far outweigh those that produce it. Just trying to separate, really what the economic impact is going to be. It'll certainly be felt. I just don't think it'll be as much as many fear. Now, of course, if this spirals, then that's a big problem. I'm hoping that, at least with China, there's some sort of an agreement that this doesn't become such a big deal, and I'm holding out hope for that. So yeah, it's a risk, and I'm not comfortable with Wilbur Ross and Peter Navarro making these decisions, because I think they're way off in this obsession with trade deficits. But I'm just hopeful that it won't be that big of an economic deal. I'm more worried about the direction of interest rates and monetary policy right now, even though, of course, tariffs are not a good thing.
What about the last day or two here of the sell-off in the FANG stocks and the tech sector. Is some of that due to concerns by the markets on the trade issues?
Well, I'm not sure necessarily on that. I mean, certainly semiconductor stocks and certainly would be potentially impacted. We certainly export a lot of consumer electronics also to China. So yeah, potentially. But I think the backdrop to the weakness in a lot of these big cap tech is a few different things. I think, granted, we know that they became such outsized portions of the major indices. When you get to $500+ billion market caps, you obviously dominate the global markets. Valuations for some of them got expensive. I mean, Facebook on a PE ratio basis is pretty modest, but on a price to sales basis, it was 10 times. So that was expensive as well. And then once you throw in rising interest rates, where people become more sensitive to valuations, and we know Amazon's valuation is off the charts, and then all of a sudden threats to their business model. You know, Facebook is built a tremendous franchise. I'm sure they'll be fine, but if it means that they're going to grow more slowly, if it means that advertisers will be more discriminating with their spend and not do as much on digital, maybe put it someplace else, well, that affects their growth rate, that affects the multiple, and stocks that have been over-owned and over-loved, and for many years, this is what you get. And obviously today, Amazon getting impacted by the talk about the White House and Trump being obsessed with them and what to do about that. There's no room for error when you got to the valuation and levels that these companies did. And now that you have both interest rate and valuation and fundamental chinks in the armor, it's obviously something really important to pay attention to, again, because they were such an outsized dominant presence in so many indices and so many ETFs and so many mutual funds.
Do you think the sell-off in the tech sector will continue and deepen?
Yes, I do. I don't think that this is somehow settled in a week with a modest pullback, considering how much these stocks have run up.
Mm-hmm. And what about instead of doing trade tariffs, could countries and central banks look at competitive currency devaluation in terms of making the currency weaker for trade competitiveness?
I mean, I think we've sort of seen a version of that for many years. With certainly the ECB wanted a weak euro, and Japan wanted a weak yen, and we wanted a weak dollar. And it seems like that is always an ongoing issue. You know, the Reserve Bank of Australia wants a weak USA dollar, and Bank of Canada wants a weak Canadian dollar, and it seems like everybody wants, unfortunately, a weak currency. And what they should be really rooting for is not a weak currency; it should be a stable currency. But everyone's trying to steal each other's exports, and I think that's just an ongoing thing that there's no sign of that changing anytime soon.
Will there be another round of that, particularly, for example, like in the U.S., the U.S. administration maybe wanting a lower dollar? Do you see that happening? And what would be the mechanism to actually effectuate that to happen?
Well, Mnuchin got so beat up, the administration got so beat up for even raising the prospect of endorsing a weaker dollar. So I just don't think that that's someplace that they're going to go to really anytime soon. I think it'll be very implicit and left unsaid that they don't mind a weaker dollar, more so than anything more outright and overt.
And what do you make of China in terms of what's happening, credit crisis, increase in credit, more infrastructure projects overall? How do you see China playing out?
I mean, it is so interesting in that, in terms of the debt accumulation has been extraordinary, and banking system has become so big that I go back and forth on how this all plays out. Because on the other hand, they still have pretty good growth rates, and I'm pretty bullish on China longer term, but certainly acknowledge the short-term challenges they face in trying to delever. Now, they're not going to do an outright deleveraging. Their version of deleveraging will be trying to grow debt less quick or more slowly, and sort of grow into it. And I hope they have success, but it's likely going to be with some bumps in the road.
Moving to a fast-moving area topic of cryptocurrencies, what are your thoughts on that? Do you think that governments will allow private-based cryptocurrencies to coexist alongside government currencies, from the monopoly power of the government?
I think only if there was more of a use of these cryptos for transactions. If they're just going to be more speculation sources of buying and selling them, I don't think they're really going to care. But again, I think if it starts replacing the payment system, then I think that's something that would wake them up.
And would that be a major driver of what you recently mentioned as potential for 90% of Bitcoin value to get wiped out?
Well, when I threw that out, I was really just talking more technically. I was referring to typically when an asset or a stock goes parabolic, that usually ends up falling to where the parabolic move began, and that was 1 to 3,000. So that's the number I threw out. That was not based on fundamentals, because I don't even know what the fundamentals are of Bitcoin. It was really just, okay, well, this is what happened in previous episodes of massive parabolic moves, and you can argue that this was probably the greatest parabolic move ever, that you typically give back the entire move. Just as the NASDAQ lost almost 90% of its value in 2000 to 2002.
And on the major currencies, dollar, euro, yen, where do you see the trend happening over the next year on that in terms of their trends, movements?
I remain bearish on the U.S. dollar, which I guess implies that I'm bullish on the others. It's hard to get bullish on the yen in light of the monetary mayhem that's going on there, but I'm not excited about the dollar at all. I think the euro surprises to the upside as well. I would not be surprised if we saw 130, 135 at some point, because I'm relatively bullish on commodities. I still like the Aussie and Canadian dollars, and I actually like the British pound. I think that the Britain's case in dealing with Brexit is everyone's still pretty down on them, and I think that actually turns out better than feared.
And what about gold? Why do you see that market as being a potential for another leg higher?
It's in part due to my bearishness on the dollar, and also my lack of any faith that the Fed can somehow pull off this monetary tightening in any smooth fashion. A soft landing is a rare occurrence, and I think there's little to no chance that they accomplish that this time around. So then, we also have the craziness that's going on with the ECB and the Bank of Japan, and I think the bull market began again in December 2015, and it's really just getting started.
And are you still bullish on agricultural fertilizers?
I am extremely bullish. I think we're beginning to see a slowdown and a decline in ending stocks for corn and soybeans in particular. The global demand for food is still in this perpetual rise upward. So if the supply situation can at least get contained, I think that there's a lot of upside. Or many asset classes that are down 50 to 75% from their 2011, 2012 peaks, and agriculture and the precious metals are two of the few that fall underneath that.
Any other asset classes that you like at this point?
Those are the two broad ones that I like. Right now, the investing landscape is getting more difficult. There are plenty of one-off situations that are interesting, but in terms of looking at it from a macro perspective, those are the two that intrigue me. I think bigger picture, longer term, I still like emerging markets. I think that the growth rates there will continue to be better, and I think valuations are much more attractive than in the U.S.
Which emerging markets in particular do you like?
I still like China, again, acknowledging the challenges they face. India, Vietnam. Actually, I like Brazil as well. And I'm actually been warming up to Greece. The Athens stock market is down 85% from its 2007 peak. And if the New Democracy, which is the opposition party, if their leader, Mitsotakis, wins in a possible early election this year or early next year, he's a business-friendly guy that would be a real game changer for that country. That has basically been through its own Great Depression over the past couple of years.
Yes, indeed. And that's great insight, Peter. Thank you very much for your thoughts, for being on the program.
Thanks for having me, Rich.
And just wondering, how can our listeners learn more about your work? Where can they go?
If they're interested in reading my daily work, they can subscribe to bookreport.com. Again, it's bookreport.com, BOOCK report.com. And I'm also the CIO and portfolio manager at Bleakley Advisory Group, and they can check out the website at bleakley.com.
Great. Thank you very much, Peter.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.